Good morning or good afternoon, depending on what side of the country you're joining us from. Happy February, everyone. It's Charlie McQueen here with McQueen Financial. Thrilled to have everyone joining us today, and super exciting. We've got some link issues popping around a little bit, so if I might see a couple of my coworkers hop on. We've been having some fun this afternoon with that. But again, happy February. Hey, so today presentation was designed to go through the economy and talk about an economic update. We're going to continue to do that, but we did some modifications. A lot of things have been happening. One of the busiest times I remember in our industry, and change is happening really fast, and that added into some education and conversations on education and comments I've made in our weekly write-ups here. I thought it was a good day to talk about a few things besides just the economic update, but tie in some of the changes with the economic update in the world that's going on, because change is happening faster and faster, and there's some big things happening. I'm thrilled here. I've got our entire team joining us. Thank you all for being here. Thank you, Corey, who's leading our marketing activities, for being here and helping out and improving the look of our things and our reports. But I also want to thank our teams. We've got our investment advisory team and our asset liability management team and our valuation advisory team, all involved, and all gave great input for this presentation today. So thank you all very much, and thank you for all continued dedication and leadership. So as usual, we've got all sorts of questions I'm sure are going to pop up. So please feel free to move around the screen and click on the Q&A button, and that'll add some great questions out there. So you're welcome to click on the Q&A and add some comments. As usual, all of our webinars are recorded, and it will be on our YouTube channel for you to check out anytime you want. If you'd love to go check out our YouTube channel, we have great education there for the financial institution world. All sorts of good webinars, information, and obviously videos to check out. So today, really want to kick things off and talk about leadership. And how leadership came to mind in this presentation is I've seen a lot of communication fail at a lot of our friends' offices and clients' offices, and watching leadership fail in ways because communication fails, but lack of decision making. And when I think of leadership, and there's lots of different definitions of leadership, you can look at it many different ways, but where I'm going today is a leader is someone who comes into a room that facilitates a discussion, talks about the good, the bad, the unintended consequences of a decision. They encourage an exploratory process, and we discuss the possible outcomes. Now, where leadership gets difficult is then a decision has to be made. And what we've seen a lot of times is that decisions are not wanted to be made because people are worried about offending people. They're worried about not having everyone in alignment. And when decisions are made, most of the time it's better that you don't have 100% unanimous vote. I like dissension. I like arguments. I like different opinions. You want people to have different opinions and sides to it. But in the end, leadership is coming down to is taking all the information available, making a decision, and going forward. And when you make that decision and go forward, not everyone in the room is going to be on the same page. You're going to have a lot of, at times where 2 or 3 or 4 or 45% of a room disagree with you. That's okay. It is okay to have dissension, and it's okay to have disagreements. It's okay to have people that aren't on the same page. But the key is when you leave that room, we're all on the same page. When we as a management team determine we're going to take an action and go forward, even if I disagreed, we made the decision to go forward, I have to agree when I leave that room. And that's what leadership is all about. It's facilitating a discussion, looking at all the options, making a decision, and moving forward. And then it's also taking those that disagreed and bringing them in and explaining why, leading with why a lot of the times at that point, why we're making a decision and going forward. This is really important today. Today we have a margin business. Well, we've always had a margin business being a financial institution, but we're also a margin business with fixed costs. Now our margin is changing quite a bit. Our yield on loans and investments is going up. Also, though, our cost of deposits and borrowings, especially borrowings, are skyrocketing very, very quickly today, given lots of liquidity issues out there. And so as we're seeing our margin change, and at first we were seeing some great margin increasing as we saw Loan rates repricing, slowly investment rates repricing. Now we're seeing such a significant increase of cost of funds that margins in a lot of places have stopped going up, and some have actually started to retrace back down. All this is happening while the cost of being in business has gone up. Fixed costs are going up, electric costs are going up, energy costs, diesel, all costs are going up, people, employment costs are going up. So as these costs go up, it's then making our fixed costs go up higher, which makes it really imperative to improve our margin. Along with that, we're seeing a reduction of non-interest income. We've seen fee income go down. A lot of people cutting overdraft fees, a lot of people cutting different fees. And on top of that, mortgage income from mortgage opportunities and mortgage activities is down. If you had an investment broker in a lobby program, earnings are down 20, 30% with the reduction of the value of portfolios down 20 or 30%. So it is a margin business, but we do have a lot of fixed activities. So it's really important that we're looking carefully at these fixed activities and that we're looking at these costs and we're making sure that we focus on that margin. With that margin, you think we do have all sorts of moving parts. One of the things that makes this a difficult business is how things move, and things don't move in a constant flow. So think about the ebb and flow of things, what's happening? Well, loan volume has skyrocketed. We'll talk about why here in a couple of slides, but loan volume has skyrocketed. And what's happened a lot of times is it's skyrocketed more so in places where people have not modified the yields. They haven't adjusted the yields to keep up with the market. At the same point, we have this other thing happening, which is quantitative tightening. We have money being pulled out of the system aggressively by the federal government, and we have people spending more money than they make. All that comes down to is that we're running into a very significant cash problem. This cash problem is a liquidity issue. When we think of liquidity, liquidity is made up of several things. One of it is investments, another one of it's cash on hand, available borrowings. All those pieces build up to liquidity. But what we're seeing today is a significant problem with liquidity. We're seeing money go out the door very, very quickly. Unbridled loan growth is happening. Deposits are shrinking. Money supply is shrinking. All these things are happening, and we need to make sure that we're thinking carefully about this. And we've got to watch it. We need to get into balance sheet management at a more detailed level. So balance sheet management is back to the basics. What do we need to do? What's the proper way to manage our balance sheet? It's great that we have growth in an asset type. It's great that we have growth in loans, but how are we balancing that out? How are we balancing out yields on loans, growth in loans to ensure that we're making a good margin and able to keep solid liquidity positions? So we think about this. We need to stop unbridled loan growth, especially unprofitable loan growth. We see people all over the country right now booking loans in 4% and 5% type yield. And the hard part is the yield of borrowings today is in the 5 and 5.5% range. So we see people booking loans at a negative margin day in and day out. I have people call me up and said they're struggling with profitability, and we start to explore why. It's because they're making a negative spread for every loan they're bringing in the door at this moment. We need to make sure, and it's an extreme example, obviously, but pricing has changed. The speed of change that I mentioned earlier is happening faster and faster. And we need to make sure that we're not only pricing, but we're pricing quicker and more effectively. We used to talk, a client told me the other day that, hey, I didn't change loan rates for 4 years. Now I feel like I'm changing them every 4 days. And my response is we should probably be reviewing them every 4 hours. Things are changing quickly. We need to stay on top of that to make sure that we get things handled correctly. Thinking of loans and thinking about this is a oversimplified example, but all of our lending and all of our deposit gathering, which we'll talk about in the next slide, it's really important that we work on a build-up methodology. How do I come up with my pricing of my loans? It's one thing. We want to look at competitors. That's absolutely right. But there's always competitors out there that are not thinking through this, that they're not planning ahead, that they're not looking at the whole big picture and saying, hey, what is my incremental cost of borrowing? Maybe this competitor has cash that they just need to deploy and it's good for them. It may not be good for you. So we do need to look at competitors, but we also need to look very, very carefully at our individual costs. So here, simple example, 5.25% borrowing rate, incremental cost to borrow. When we're bringing a new loan in, we've got to look at the new cost to fund that loan, not look at our average cost of funds, but as we bring that new loan in, especially if we have to borrow, what is our incremental borrowing cost? Then add a servicing cost, then CECL. And then we need to look at what is the return we want. We want a 1% ROA. So going through this math, 5.25, 50, 75, 1 equals 750. At that point, that would be the neutral rate, 7.5%. If I want to slow my slow my loans, which are resulting in borrowings, I need to be higher than that, maybe 850. I need to be above the market. And so it's important that we work to a neutral rate and then we go up or down from that neutral rate to make sure that we're hitting a number that's going to provide you the volume that is appropriate for you. On the deposit side of the equation, deposit costs have not come up as much as I expected at most of our institutions, but we see them coming up very quickly, very soon. We're seeing people continue to misprice deposits in ways that if they want to bring deposits in or retain deposits. The reality of the market today, 3% savings rates, 3.5% money market rates. A lot of the big brokerage firms are at 4%. American Express is at 4.5%. We're seeing people go to get money and get CDs brought in. It's 5% for 6 months, 6% for 1 year. Definitely very, very high rates we're seeing right now to bring CDs in. One thing to remember, the CD market has changed. Most millennials, most Gen Xers don't have CDs or know what CDs are. So growing CD deposits is going to be very, very difficult from your membership as your membership changes over time. So we are seeing lots and lots of yields out there today that are much higher than expected. And what's going to result here is our cost of funds will come up quickly. So that loan pricing page here, it's extremely important that we really think through this loan pricing and we do a build-up process, not only for the margin today, but the margin that will hit as we go forward, because our overall balance of all of our deposits is going to go up. We're going to see our overall cost of funds go up very quickly here throughout 2023. So really need to make sure we're planning on that happening as we price loans today. So part of the result here is earnings are absolutely paramount at all times, but even more paramount when our capital ratios get lower. A couple things we're dealing with today. We are seeing, obviously, we had large asset growth over the past few years. The pandemic cash coming in caused assets to grow overall, which reduced capital ratios. Now we've had this unprecedented move of the Fed raising rates 450 basis points in a 6-8 month time frame, which has caused now massive changes in the value of investment portfolios. Lots of negative values from an OCI standpoint. And then now add on top that CECL, where we have to do a one-time CECL transition. These are going to help our net worth and capital ratios, but overall equity has declined quite a bit. And this is going to continue to be a spot that the regulators are going to focus on, along with earnings here, is going to be capital, levels of capital, generation of capital. And so we're going to want to make sure that the business that we're putting on our books, our new loans, all the activities, deposits, that we're doing it at a nice positive margin to improve earnings. So definitely a spot that's going to be a highlight by the regulators here as we look forward to the future. So if we think about market positioning, I love this term. I wish I was the one that coined it. I've used it 1,000 times, but never waste a good crisis. Obviously, a lot of things are happening today that are very fast changing. A lot of things are moving in our industry quite a bit. But don't waste this crisis. Don't waste this opportunity to change your loan rate setting process. Don't take this to forget that we now can change our deposit structure and the types of deposits we bring in. And overall, your marketing process. The users of our institutions are turning over. Older people are falling off. New people are coming on. Utilization of branches is changing. We can take this opportunity to change how we work and what we do. So really, really important we think about this and we move slowly but diligently to change the overall structure of what we do and how we do things. Now, it's interesting. I was thinking about market positioning, having a conversation with someone who was asking, well, how do I work with some of my loan department? My loan department is paid on a volume basis, my indirect lending loan department. And, if we raise rates to what we think we need to, they tell me they're not going to get any volume. And I thought about it for a minute and I said, it's funny, being from Detroit, of course I know about cars. I have to know about cars, right? But I said, we also know a lot about mortgages. We have the two largest mortgage companies in the country, literally about 8 miles north and south of our office here. And I can only imagine a loan officer walking into the CEO or the CFO's office at at United Wholesale Mortgage or Quicken Loans and walking in and saying, hey, I know the market rate is 6% on 30-year mortgages, but I want to do more volume, so let's do them at 4%. And I can see the CEO thinking and the CFO thinking and going, so we're going to lose 2 or 3% in value on every mortgage we write. So you want me to lose $3,000 for every $100,000 mortgage we write? And I can only imagine, are they going to throw them out of the office, out of the building, or out of the state? Mortgage companies would never go down a path where they're going to lose money on every loan, and they pay their loan officers on commission. And so something to remember, when you're paying people on commission, you have to give them the parameters that allow that commission to be earned. And you have to be profitable to pay that commission. And that's why commission employees make a lot of money when things are good. They make a lot less when things are not good. And in the end, it balances out to a salary position. They just have to be able to accept the volatility. So to me, it's really important. We don't want to waste a good crisis, but we also have to be responsible to understand how the business should work and the things that we should be doing to make sure that our margins are attained and sustained for the long term. And so thinking of sustaining for long term and talking about market participants and the world is changing here, and I talked a bit about the mortgage industry. When we look at other types of lendings, it's important too to think about who the players are. We saw a massive swing of car lending going into the credit union industry. Wall Street Journal ran several articles talking about how credit unions are just taking over the entire spot. And in the end, a lot of this went there is because auto companies exited. They didn't have cash because of pandemic activities and supply chain problems. A lot of funds that would buy auto loans weren't buying them because they couldn't borrow money and make a positive spread. A lot of institutions that are bigger in the space were running low on capital, and they exited the business. And so all of a sudden, all this comprised with liquidity constraints taking place, people that weren't paying attention and changing their rates got hit with huge, huge volume. So it's really important to remember that you have to control your volume, not only based on interest rates, not only based on your liquidity position, but also the liquidity position and the needs of other players in the market. As you could come with a whole bunch of loan volume and that you did not anticipate nor want, but that was there because of where your pricing was being set. So really important, make sure you think about the participants in your market, and when those participants change, your loan pricing needs to change. Something we all don't always think about, but something really, really important to think about. So with that, I want to talk about some data to help us make some really good decisions, continue to make good decisions, and even better decisions as we go forward from here. So a lot of different points I want to hit on, and I want to go back and continue to bring in theories and thoughts from our leadership discussion into where we go from here. Now, this presentation is a lot easier. Last one I did was the day before a Fed meeting. I like doing these the day after a Fed meeting. Makes my predictions a lot more accurate. Well, for here, we've got a few things to go through. We're going to talk about inflation and delinquency and deposits, employment, housing, a little bit of the yield curve and some projections. So for all of you that listened to Fed Chairman Powell talk yesterday, there was a focus on inflation and how inflation has turned down. It's still very high. It's the highest inflation we've had from the 80s. A couple things. We've seen the Consumer Price Index, all items, which is the black dotted line here. It has obviously come down. We were up at 9%. We're in the 650 range. A big improvement. The one that I really want, but that is, let me back up, that is a volatile one because energy prices, gas prices, natural gas prices have all come down substantially. Some of this is going to be based on the re-lockdown of China, now the re-release of people in China, which probably means utilization of gas and oil is going to go up, causing a reversal in some of these numbers. But the Consumer Price Index, ex food and energy, this is taking out volatile food, volatile energy, removing bird flu, egg prices, all of that. We're not too changed. We're all the way up at 6.5. We're down just below 6 now at a 570. But this has been fairly consistent high here, and this is something the Fed has to pay very, very close attention to. The good news is the last prints are down here. Also with the PCE, it's down a little bit also. But still, these are very elevated areas that the Fed does not want. Why does the Fed need to keep inflation low? Well, you have to make sure that costs are reasonable as hyperinflation causes people's savings to be wiped out. It causes things to cost too much. Wage growth needs to keep up. All sorts of pieces of the puzzle here. And the Fed does have their dual mandate, price stability and full employment. We'll talk about full employment in a couple of slides. The price stability is still a challenge. And the Fed did say yesterday that they do expect to raise the Fed funds rate at the next meeting, which would get them up to a 5% range. If they do 25 basis points, they would do more higher. Now, what are the big issues that have caused caused inflation to go up? Well, it's energy prices. Energy prices are up over 20%. Again, this will come. It's been coming down, and it will go back up because of China. Food prices, and this graph's a couple weeks old, so eggs. You add eggs on here, that's going to bump things up. But these have been the big issue: food and energy, and that's going back to that last graph here. You can see that they went way up and they've come way down. But this is what we really want to focus on, is the standard consumer prices. So with that, with these prices going up, there's a positive. The value of people's homes are up, the value of their assets are up. So it actually makes it a bit more difficult to lose money on loans, which is a positive. A bit more difficult to lose money on loans. I love that. It's a positive. Because what happens here, it's hard for me to walk away from my home when my home has lots of additional value in it. And so looking at this, we're seeing positives from a delinquency standpoint in the big picture. And we're seeing that our 90-plus day delinquency is still very low. Car loans are still a bit higher than what I'd want here at 4%, but given where we've been for the past few years, it's reasonable. Home equities are low. Credit cards overall are low. But when we start to look at this, delinquencies are going to be up. I'm going to show you some more recent charts over the past couple of days and some specific products, but charge-offs are still low. We haven't seen charge-offs come up, but overall we're seeing delinquency back to pre-pandemic levels, if not a little bit higher. Now, a couple things here, looking at the Wall Street Journal data and some company financials, really interesting to see here. We're beginning to see some turns and trends. So here's credit card 30-day delinquency. We have Capital One right here and Discover. Now, American Express is down at the bottom. One would say that American Express tends to be more with a user that is going to pay off their card every month versus Capital One and Discover, which are more towards the masses. So we're beginning to see that come up. Back to pre-pandemic levels, though. So it's interesting to see. We've gone through the free, easy money, and we're now back to a normal type environment. Now, looking at the next box here, Ally Financial and auto loans, and we're now seeing that their 30-day delinquency and 60-day delinquency are back above pre-pandemic levels. So things are coming back up. 30 days always a bit volatile, but 60 days definitely going down a trend. This is something we're hearing from a lot of clients, is that we're really continuing to see delinquency head up, but charge-offs stay low. It's change. Also, a couple interesting articles in the Wall Street Journal you can read about, the foreclosures and repossessions of cars starting to tick up quite a bit right now. So switching from loans to thinking about what's happening on the liability side of the balance sheet and the deposit structure, we're definitely seeing a lot of massive changes here. And this is really causing us to really need to change our loan process and our loan underwriting, our loan rates. It's because of the liability side of the balance sheet. Now, risk is up. We just talked about that there. We're seeing higher risk, but we're also seeing it more difficult to get deposits in the door. And this should not be a shock for anyone on this call. You guys have seen this graph from me many, many times. This is M2, money supply. What we had here is our normal growth of money supply. We got a bit more liberal with activities in 2010 to 2020, stimulus activities. But then the pandemic stimulus happened. That right there is 5 years worth of money supply that happened in about 3 months. And it even continued for another 5, 6 years, 7 years. So we went up about 8 years, 9 years of money supply in just a year and a half. And now we're beginning to see it come down. So we had all this money come into our balance sheets, and now we're seeing it come down. And so that's the hard part. It's great to have the money come in, but then when the money comes out, it's been coming out faster than we anticipated. Now, we've been very responsible with investing, keeping portfolios in a very short 3-year type average life structure. But as fast as the Fed's raised rates, they've gone to quantitative tightening unbelievably fast, the fastest they've raised rates since the 80s. And what's that resulted in is deposits going out the door. And if we look at this here, the FDIC, now this is through September. When the December data is published, I'm sure it's going to be even a bigger decline. But now we're looking at substantial drops of deposits in the entire banking system, and it's going to continue as we go forward as the Fed is pulling money out of the system. Now, we have a couple ways of different things happening here. One is Fed pulling money out of the system, but also we have is people spending more and saving less. And so we look at saving less here. We hit nearly an all-time low on savings rate. Just here recently, we were down to 2.3%. We average closer to a 5 to 6% savings rate, 7% savings rate over the long term. But we can see here with the pandemic funds, the multiple stimulus packages that went to people, all that cash poured into the system, and that is one of the biggest drivers of inflation right now is all the money that's come in. So now we've bottomed out. Now we're starting to see a little tick up, and we'll talk about that in 2 slides. But we definitely are seeing people spending more money than they make. Savings rate is effectively negative for a large chunk of the population. Overall, it's still positive, but very, very low savings rate, which this is all resulting in more money coming out of the banking system. So lots and lots of changes. Now, looking at this a bit more granular, this is a really interesting graph the Wall Street Journal put together. It goes back to the Census Bureau, St. Louis Fed, Labor Department, all sorts of information they pulled together here. Very, very interesting. What this shows here is that people making less than $50,000, the amount of people with negative savings has grown is up 7.2%. In the $50,000 to $100,000 range, it's up by 2.6%. If you make $100,000 or more, it's the number of people with negative savings is up 1.7%. So we're seeing just these massive, massive changes. And so we're seeing here, this chart is share of U.S. adults whose monthly expenses were more than their income by household income. We're seeing a massive percent. And here is the baseline, 20% of all people that were earning less than $50,000 were already losing money. Every month they're spending more than they made. And that has now grown since zero here up to 7.2%. Now, people that make $100,000 or more, they're already running about 8% were spending more than they make. It's relatively unchanged. We saw it actually dip to a positive improvement. But here what this tells us is that people are still spending more than they make. That is not a good outcome. It's an okay outcome when money is basically free. It's cheap to borrow. But when money becomes expensive to borrow, the numbers get worse very, very quickly. So one of the big concerns. So what does that mean? Well, we're going to see spending change a bit. And we've started to see spending change, which has bumped up the savings rate a little bit. I have another chart here of the savings rate on the right-hand side. But if we look here, this is spending changed from January 2020 to now. We have the recession when spending went down real quick. We're all locked in, couldn't do anything. But as we came back to life and spent money, our spending was growing up in the pace of 30%. Well, we've now seen this downturn. Along with the spending, consumer prices have gone up, which has made things more expensive. To facilitate the spending, the savings rate, as we can see here, we got this big bump up in spending, correlates with this big bump down in savings. And so what we ended up seeing here is people started saving less money and spending money, especially when we got past the pandemic funds. And we've driven savings down to almost zero to cover this retail sales. So it's starting to change. We're going to see retail sales slow, and we'll see hopefully at some point less of an outflow of deposits. But we're still going to see people spending more than they make. This is a base level problem. Again, 20%, 10% of people spending at the beginning more than they made. Now we're almost up to 30% and up to, we'll call it 15% now. So we're getting a large percentage of people, especially in the lower income demographics, are now getting to a spot where they're really going to struggle. So all of that put together on one simple slide. Great article I read the other day, and they highlighted this graph, which is from the Federal Reserve Economic Data. It's real disposable income. And what this has shown is that people have been spending substantially more than they make, and that their disposable income has come down in a large, large amount. Now, it was propped up here quite a bit from pandemic activity, but now it's come down. So what this tells us is the same thing as the other charts. It is going to be difficult to have lots of good income coming in, lots of good additional spending coming in, and most likely a contraction of people's spending habits as they have to realign their spending with their income. And also with the higher cost of debt, they need to realign their spending with their net after debt income that they have to do. So lots of changes coming in. We expect those changes are going to continue to modify, and we're going to see more here that hits our gross domestic product number. Now, this is the value of all goods and services created in the country. We've been on this trend down here a little bit. Obviously, we had the heartbeat here, which was the fall off with the pandemic, the fall back up with the pandemic. But we expect this number, I was expecting to forecast closer to zero, but as we forecast now, we expect it to be a bit higher, partially because of the value of the dollar and looking at what's happening with currencies, that we'll see that we should probably get a continued positive GDP, but it's going to be a low number and a little bit lower, I believe, than what people think. So with that, we talk about the Fed having a dual mandate: price stability and full employment. So price stability we covered, talking about inflation, CPI, CPIX, food and energy. But now we have this unique situation of employment and people participating in the employment world. Now, with the Fed raising rates, one of their goals is to lower inflation. And one of the ways you lower inflation is by removing people from the employment roles. That's one way to accomplish that. So as we look at what's going on in this world, employment is really, really good. Unemployment is extremely low. National unemployment, 3.5. Here in Michigan, we're at 4.3. Unemployment weeks down to 19.5. So we're seeing these near record low levels. This is where we were right before the pandemic. I mean, we're at really low levels. A lot of economists believe that 5% unemployment is full employment, that everyone has a job when there's 5% unemployment, because you need a little bit where people are moving jobs and wanting to change. So the hard part here, though, is when employment is tight, costs go up, employment costs go up. The cost of employees go up, you have to raise the cost of goods and services. As the cost of goods and services go up, people have to charge more to be able to buy those goods and services, and you get this circular pattern that keeps going. And so a little higher level of unemployment would be a good thing. We are seeing wage-based inflation slow dramatically. I've seen a lot of changes in the number of people employed. Now, before I talk a little bit about number of people employed, it's a really interesting activity. I know a number of you have seen this graph a few times from me. This is the labor force participation rate. Back in the 60s, 70s, 80s, we were going up in the 60s, 61, 2, 3, 4, 5. And what happened back here, percent employed, we had women entering the workforce in droves back in the 70s and 80s. Lots of changes. We had baby boomers, and we ended up getting all the way up to about 67, 68%. Now, we came down quite significantly, and then we had the pandemic, and we're down. We're back to where we were, about 1976. This low level is attributed to a lot of things. One of the biggest issues out there is lack of childcare. Before care at school, after care at school, be able to have people watching children in daycare centers. It's either unavailable or extremely cost prohibitive. Schools have struggled with that, and that's one spot where it's been extremely difficult. So we're also, along with that, with having problems and maybe one parent staying home with a child, we're also seeing that sometimes people that were in industries that were getting close to retirement, they've decided to leave. People that were in the healthcare didn't want to be involved in healthcare anymore, and they decided to leave. A lot of things have caused changes here, but it's a very low level of people participating, which makes it even harder to find more employees. So definitely some structural unemployment, definitely some incentives not to work that are slowly going away. Some of the last pandemic bills are going to be, I think, removed in May, we've heard now. We're forecasting the pandemic's done in 5 months. I love that conversation. But we are seeing changes here to the unemployment spot. And one of the things that's made a lot of headlines is the tech company issues that have taken place. Tech companies have been laying off a lot of people. This is a chart, techemployment.com, and what they're going through here is the cuts. There's some big numbers, 12,000, 11, 10, 10, 8, and so forth. So far this year, There's been 192 announced technology jobs lost in 2023. So in 1 month, 192,000, call it 200,000. These are the ones where people are required to announce. I'm sure there's many others, but there's been some right sizing. A lot of people overhired, now they're underhiring. How material is this? It's some big numbers, but a lot of these companies employ hundreds of thousands of people, so it may not be as big as what individually we think. But there's definitely a tide changing right now. We expect that the unemployment level to stay flat, to maybe go up a little bit, as we're starting to see these activities flow through. And again, companies are looking for cost savings because all the costs of goods and activities have come through pretty darn high. So with this, we have employment changing a little bit. We have inflation still high and coming down. We have an interesting issue that's happening in the housing market. And this is another great area where we achieve a lot of loans from, which is going to be a challenge for a while. So if we think about the housing market, we've built way too few homes for way too many years. We've been building about 400,000 new homes from 2009, 10, 14, 15, and then we started to get closer to 600,000 homes in 17, and we eventually popped up to almost 1 million new homes here just a couple of years ago. We've quickly reverted back. What I can tell you is we were closer to 800,000 to 1 million for the previous 10 years. We did overdo it at the peak of the housing bubble, but what's happened here is we've underbuilt homes. And so we do not have enough supply for all the people that want homes. We're working hard at it, but it's also become very expensive to buy homes. Now, this is used home sales. Used home sales has dropped substantially from 7 million to 4 million. I expect it to continue to come down very quickly. It becomes financially very hard to sell a house where you have a 3% 30-year mortgage and a $1,000 a month payment, to go and buy the same house around the corner, or the same value house around the corner in a different state, and have your payment double or triple for that same house. Very, very cost prohibitive. So we're going to see a lot of people not want to move because of where interest rates are. We've gone from 3% in 30-year mortgages to 6.25%, 6.5% today. Very, very expensive to the borrower to swap like-sized houses. So with that, value of homes has skyrocketed. And this chart here is the Case-Shiller Home Price Index in red from 1998. We go through the housing bubble here where it went up and came down. And then you'll see this market increase that happened since the pandemic. The significant increase, and what we can correlate that to is the significant decrease in 30-year fixed-rate mortgages, where we basically went down to 3%. So as mortgages got cheap, that allowed people selling houses to charge bigger prices because that bigger price was affordable. Now that mortgage costs are back up here, the highest they've been in 20 years, is the mortgage rate today, the highest it's been in over 20 years, we have to see this value number start to come down. It has. I expect it'll continue to come down because people can't afford to buy houses at the prices where they are. So with that, where does this all mean? Where do we come to? What are the best decisions and things we need to think about today? Well, where we are is the Fed is going to keep raising rates until inflation is stopped. I expect at least one more increase this next meeting, maybe 25, maybe 50 basis points, depends on a lot of data that comes around. But what the yield curve is telling us is that the Fed is near the top. We have an inverted yield curve. Short-term yields yield more than long-term yields. We're inverted all across the entire yield curve, which is a great indicator to us that we're reaching the top of the rate increasing cycle. We're not there yet. We might be at the top for a while, but we're reaching that number. So today is a good day to buy investments. It's a good day to buy some 5-6 year investments and extend our duration a little bit. It's a good time to buy stuff that actually does not have options. I don't want to give away any optionality. I want things to be able to come back and not come back to us except when I want them to come back to us. I don't want to give call options up. It's a good day to invest a little bit longer. It's a good day to think about, this is a nice spot to be yield from an earning asset standpoint. We also, though, want to be very careful. It's a hard time for people to afford payments. When we talk about commercial loans in the 7s and 8s and car loans in the 7s and 8s and 9s, you start to look at those payments. Those payments are difficult. We're also seeing used car values decline. So we're seeing a lot of changes here, which can make current loans much riskier than loans we've made over the past few years. And remember, changes happen very, very quickly. We talk about how the Fed normally raises rates. We get this nice step pattern, and they keep going along as they were raising rates in 17, 18, 19. And then we have the cliff with the pandemic, and then we have the rocket ship. We've got the starship shooting up directly up here to 475. A massive increase of yields in a very, very short period of time, which has caused a lot of instability into our industry and our market. So what happens next? It looks like the Fed, and if we look at the Fed funds futures, are predicting, rightly predicted here, that we're going to go to 475 on Feb of 23, excuse me. And it's predicting another 50 basis points here in March, our next Fed meeting. At that point, the futures are saying that the rates are going to be unchanged until November. As of November, we're looking at potentially a 25 basis point decline. Some models are now showing 50 basis points in December, but we're starting to see that there's predictions in the market that rates are going to go down end of this year. Now remember, the Fed funds futures is always wrong. It's a good indication to think about where we're going. The mountain is usually not right. The direction usually is right. This was way off back in the beginning of 2022, so don't hold this as a perfect thing, but it's a good indicator for all of us to realize that the market is starting to bet that the Fed is at their high point of rates. And one of my all-time favorite charts, all of you that know me have seen this 1,000 times. What we have here is the Fed funds rate in red, and the black dotted line is the 10-year Treasury, and the blue line is the 2-year Treasury. If we go back through a normal cycle, here we go back in 2004, 5, 6, 7, 8, Fed was raising rates. We got the Fed funds rate above the 2-year Treasury, above the 10-year Treasury. They kept it there for about a year. A full-blown recession had come into place. They over-tightened. The housing market bubble burst, and then rates came down. And we hit this really low floor spot for a period of time. But what we see here again is as rates came up, we got a very flat yield curve. This is an inverted yield curve. And then we went back to a normal steep yield curve. And then we repeat the cycle. So as we look over here today, we're seeing the 10-year Treasury. It's fallen through, and it's lower than the Fed funds rate. The 2-year Treasury and Fed funds rate are darn close here. This graph needs to just get a little update there, a little bit higher. So in a lot of ways, it looks like we're somewhere right here where we were in 2005, 2006. So from here, do we expect a recession? We're probably in a little bit of a recession right now, or a slowdown, whatever you want to call it. I always love the joke, what's the difference between a slowdown and a recession? In a recession, I lose my job. In a slowdown, someone else loses their job. What does that mean? Well, I do think this is going to be a mild downturn. I believe we're already in it. It won't happen for a very long period of time. It won't be anything like 2008, and the reason being is back in 2008, we had deflation, and we didn't have the inflation. Now, we've had a lot of inflation, which has put asset values at a positive mark. So the likelihood of people losing homes and walking away is going to be much lower than it was back in 2008. We also have an expectation of government to help. We've got a lot of moving parts. We've got a lot of onshoring of business, which will help keep things going stronger in our country. A lot of different moving parts this time. And the one thing I've learned is this change is constant. Change should be easy until it comes to me, which makes it really difficult for me. But every recession, every downturn, every cycle we go through is different. And this one is different. I think it's going to be more mild than ones in the past. There's still a lot of money, a lot of people close to retirement saving money and investing it, so maybe it won't be as bad on the stock market. But we are definitely going to see a downturn. I also don't expect rates to go down nearly as close as we were to zero. We're going to come back down to more of a normal level, maybe the 3% type range, back to what would be considered a more normal Fed funds rate, overnight funds rate. So with that, no one can predict exactly what is coming up next, but I do think there's a lot of possibilities of different outcomes. I think it's going to be a mild recession. I think it's going to be something that we get through fairly well, but it's going to be a challenge. We're going to see job losses. We're going to see, with now much more expensive borrowing, which is going to make cash flow difficult. It's going to make cash flow difficult on commercial borrowers. It's going to make cash flow difficult on consumers. And so as we think about this, I want to remember that leadership is difficult and rewarding. Making decisions that everyone doesn't agree on is imperative, and making sure that we're making decisions at all times. A lot of mistakes I've seen where people said, hey, I don't want to change my loan rates because my lending people don't agree with my CFO and we're not all in alignment. Let's wait a couple weeks and come back and talk about it again. And what that's done is caused bad outcomes to happen during that time frame. So making a decision is much better than not making one. Liquidity is absolutely key right now. We always talk about capital is key and making sure we manage capital, but liquidity is going to be the biggest issue that we're going to see here for probably the next 6 months, and a continued focus on liquidity management, growing liquidity, making good decisioning on pricing of loans, good decisions on pricing of deposits is absolutely going to be paramount. I expect that we're going to see overall cost of funds come up quite substantially. It's okay. Our yield on assets is continuing to go up. We just need to make sure that we manage that process of raising our cost of funds so we don't get clobbered in a forward economic environment. So with that, it's important that we really rethink pricing. We really need to rethink our pricing meetings, our pricing strategies, and bringing more people into pricing discussions and ensuring that those that have conflicts in pricing discussions, that it is fully outlined and put on the table so people can weigh that person's opinion based off of their personal income or the best interest of the institution. So it's really, really important here. One thing that I can guarantee you is that the speed of change is getting faster every day. 2023 is going to have a lot of changes. I think they're going to be wonderful, exciting changes. There's going to be some challenges. But in the end, it's a great market to be in because we can make a nice margin. We're back to a level of good margin and good earnings. So with that, I want to pause, open up for a couple quick questions. And I also want to talk here, I'm really excited. Our next webinar coming up is that we have an EBPA and CDA webinars coming up on February 15th. We're actually going to be talking about charitable donation accounts. Super excited. We have a couple guest speakers that will be attending that and going through the different things that we do. In some ways that we've actually been helping some of our clients make some incredible impacts on their communities. And then we're also going to be doing a EBPA, Employee Benefit Pre-Funding webinar on February 22nd. Same thing, we're going to have some special guests and look at ways that we've been able to work on some retention and other activities. So with that, I really want to thank everyone for joining us today. Please reach out to your MFA advisor and have some conversations with them about what is happening and pricing and thinking about what can be done. 2023 is going to be an exciting year. I do expect deposit generation to be tough, loan pricing to be tougher, but great success will come out of all of that. Thank you, everyone, and have a wonderful day.